Morning, ladies and gentlemen. It's a pleasure to be here this morning. It feels like we face on a daily basis a barrage of bad news for the South African market. So yesterday it was the turn of the public protector to suggest we should change the mandate of the Reserve Bank, and there's just one story amongst many that I think kind of weighs on us and leads us to contemplate what the future for South African financial markets and financial assets is. So I've titled this brief talk. I'm going to be speaking for 25 minutes. Is it really different this time? Is what we're experiencing just noise and markets will look through it, or is there a fundamental shift going on that we should worry about in terms of prospective returns? And so just a selection there of newspaper headlines. You'll have been familiar with them. South Africa on the brink of disaster, junk status puts country on knife edge, and still they come at us. And so in this struggle that we're in, it felt to me a little bit like when I was putting it together, we are in a good versus evil narrative. And so I drew on the work of J.R. Tolkien, an author born in Bloemfontein, not so far from here, and his epic good versus evil struggle or story, The Lord of the Rings, where I found a number of quotes that seemed to me to talk to some of our particular narrative going on in South Africa right now. It also talks a little bit to my own teenage past, where I spent an inordinate amount of time in the wargaming club, avoiding the first 15 who were quite intent to tie me up or push baked beans up my nose. And here is, I guess, the element of that story that we're most familiar with of late, the question of South Africa's credit rating. We've presented on the left-hand panel the rating of our foreign currency bonds, and on the right-hand panel our rand-denominated bonds, the local currency, for the three main global rating agencies, Moody's, Standard & Poor's, and Fitch. And the timeline from the point where we actually were given ratings back in the mid-90s. And one of the key takeaways, I think, for us and for investors is particularly on the right-hand side of this chart, the panel where we look at the local currency debt, and we can see, we are rated now by all three agencies lower than we were back in 1995 when we first re-entered the kind of global capital markets and were given a local currency rating. So Fitch, probably the least important of the three agencies for us, currently rating us junk, and sitting on the cusp of junk with Standard & Poor's and Moody's. So that's the challenge. How do we behave as investors against that backdrop? One of the things that we would say is you can't know what is going to happen. So be very cautious about putting together a story in your own mind that requires a whole sequence of events to occur for it to be validated. So that story might currently go something like this. State capture leading to an undermining of the national treasury, a worsening of our debt metrics, further ratings downgrades, rand weakness, inflation takes off, interest rates surge, bond markets and equity market collapses. So I think that's a kind of narrative that seems quite kind of seductive, and given the headlines we're reading in the press, somehow quite likely. And yet, even if the probability of each of those outcomes is, say, 70%, when you string them all together, the chance of your story in the end being validated is probably less than 50%. And so, what we would say is buy assets that are cheap, buy assets that pay you to own them, where the risk premia are elevated. That's first prize, because As Gandalf said, and he was a wizard, even the wise cannot know all ends. So, exploiting risk episodes, let's look at a recent one that really kind of captivated us and is a great example. This is, on the left-hand side of this screen, is the 10-year government bond yield in South Africa up until the beginning of December 2015, and I think you can be pretty sure you know what's coming. On the right-hand side is our estimate of what the prospective real return was that that asset offered you at that point in time at the beginning of December 2015, offering you in real terms 2.3 or 2.4%, which in Prudential's framework was approximately fair value. So bonds looked like they were fair, it was a decent investment, and then kind of unexpectedly something kind of fairly dramatic happened, and the finance minister was replaced by somebody nobody'd ever heard of, and bond yields rose 200 basis points overnight. The real yield rose from 2.25 to 3.5, and you had something like a 10% capital loss on your bonds pretty much overnight, which was fairly unpleasant. Interestingly, and Peter Hugo will pick up on this, what happened through 2016 following on from this is that people sold bonds and they took money offshore. And we'll look at that strategy and how it performed. But what's the bond market done subsequently to Nenegate? And alongside the ratings downgrades we've had and all the bad news, bond yields have fallen. Where have they fallen to? Well, in fact, they're exactly back to where they were before Nenegate took place. And again, for us, it just says, you don't know what the outcomes are going to be. And even where you get the outcome right, you need to be fairly cautious about how you draw your financial market implications from that, because cheap assets have a habit of performing well even against a backdrop of bad news, which is exactly what we've seen here. So in return terms, what have those bonds delivered to you? Well, since the end of December 2015, you've had an 18% cumulative return in your bonds to the end of May 2017. So roughly, you've got a year and a half, and you've had an 18% cumulative return. Cash has given you an 11%. Those who took their money offshore and put it in global equities, which is the best performing global asset class, by the way, if you'd gone into global cash, you'd be significantly worse than this, still have yet to get their money back. So global equities, you put 100 Rand in, you've got 98 Rand now. So, the chasing of or responding to past performance in your asset allocation is generally a loss-making strategy, and Peter has a lot of evidence on that. One of the reasons why we weren't too surprised that actually the negative story about a ratings downgrade wouldn't be so bad for South African fixed income assets was because we went and looked at a whole host of other emerging countries at what happened to their bond markets when they got downgraded. And so on this chart, just to explain it, we've got 24 months before and after the downgrade. So the 0 point, the vertical line, is the point where they were downgraded from investment grade to junk. And the lines are the change in the individual country's bond yields. So, if we look at Portugal, their yields rose 800 basis points or 8% before they were downgraded. And in the 2 years after that downgrade, they've fallen by about 600 basis points or 6%. If you look at the average line there of these different emerging markets, by 2 years after the downgrade, you've recovered all, and in some cases slightly more than the losses that you experienced in the 2 years before, despite the ratings downgrade. If we put South Africa on there, we have a slightly different profile to most of those countries, although there is a fair bit of variability. We had our big sell-off in the run-up to Nenegate, and since that point in time, bond yields have been falling. But I think broadly, when we look at this chart, we would say it's a brave investor who says, I want to sell my bonds now because we've been downgraded. Because the international experience generally supports the notion that actually, post-downgrade, those assets perform well. There are exceptions to that, and the two notable ones, they're not on the chart because they went stratospheric. One is Greece, and the other one was Uruguay. And both of them were in a situation where they had multiple notch downgrades that followed the first downgrade to junk status. And in that world where things deteriorate rapidly and you enter a kind of death spiral in your policy regime, then things can certainly unwind in a very precipitous way. But a notch, or in Brazil's case, they had a 2-notch downgrade. They went from investment grade to junk, and then they had another downgrade after that. Brazil, since their downgrade, it's the golden line here, which is a little bit difficult to see, but they're down here, and they've more than recovered their sell-off from when they were downgraded. One of the other things that we would say is, let's turn to a kind of bonds 101 framework. What are the drivers of fixed income yields? And probably the three most important drivers in South Africa are short-term interest rates, inflation, and the rand. Clearly, inflation and the rand are kind of intimately related. But we had a look at the ranges that these different indicators have actually taken in the last 10 years. So if we look at the repo rate has been, in the last 10 years, has been as low as 4.5, and it's been as high as 12. The inflation has been as low as 3 and as high as 14. And the red dots show where we are now in those ranges. Bond yields have been as low as 6, and they've been as high as 10.5. If we look at the red dots, the repo rate is well below the midpoint of its range. It's in the bottom half of its range. Inflation probably in the bottom quartile of its range. So two of the important fundamental drivers that you would say of bond yields would suggest that bonds themselves should be in the bottom part of the range that they've experienced. And added to that, when we look at the rand, and this is on a slightly different basis, the rand, we're looking at purchasing power parity, cheapness and expensiveness, purchasing power parity relative to the US dollar. So we're currently sitting not far off 10% cheap versus the US dollar. And that's another factor which is important because, as I'll come to, international investors have been an important buyer of South African financial assets, particularly South African government bonds. And so for them to buy when the rand is cheap, that's an additional benefit to them in terms of their prospective returns. And yet, when we look at where bonds are, we see bonds actually a little bit above the midpoint of their range. So, those fundamentals are not being reflected in our bond yields because there's a risk premium being embedded in fixed income assets. But these fundamentals are, we would say, they are a gravity on bond yields that are one of the forces that's been has been pushing those bond yields lower despite the negative news that we've had. And hence why we say, don't be short cheap assets. And coming to this question of how do we put South African interest rates in a global context, foreign investors own about 35% of the South African government bond market. And there is quite a lot of good news, I think, when we come to look at South Africa versus other emerging markets. So, it's an area I think that we underappreciate because, we look at South Africa in isolation. We're here and we're experiencing it as our kind of sole point of reference. But global investors are comparing us to the possibility of investing in Brazil or Turkey or Russia or India and other high-yielding bond markets. And in that respect, at least, I think Pippin Took was right in suggesting that South Africa stands at least upon its knees and possibly even on one leg. Now, one of the narratives that we've had is that our indebtedness is getting out of control, and there's some additional concern on that given the change of the finance minister. If we look at government debt to GDP across 5 different emerging markets, and we've also got the G7 on there as well, the darker line at the top, we can see, there has been, in many cases, there have been rises in debt to GDP, especially in the G7 markets. Where does South Africa stack up in this regard? We're pretty much mid-pack. We've had, we were in a very good position before the global financial crisis hit, so that helped a lot. Debt to GDP was just only a little bit over 20%. We've kind of more than doubled. We're kind of hitting close to 50 now. But if you're an international investor and you're comparing, I think it's reasonable to say it looks okay. It's certainly not a huge negative. That I think when we, in isolation, looking at it, kind of say, whoa, we're really worried about this. We also kind of forget that actually we have some really great institutions embedded in South Africa in terms of, if we look at our judiciary, the Reserve Bank, the freedom of the press, the quality of our financial market regulation, our corporate governance guidelines. A lot of those are top-notch, even compared to developed markets. So when the World Economic Forum, which is a global think tank, looks at roughly 150 different countries and ranks them against each other on a whole variety of measures, one of them is the quality of the country's institutions. And we look here, we've got 5 different emerging markets there. We've got a timeline of the last 10 years. And South Africa, a higher score is better. South Africa ranks best across all of those markets. So again, we worry that our institutions are being undermined, and there's some modest evidence of that in the timeline over the last 3 years. But compared to generally what's going on and against other emerging markets, it's a feather in our cap, not something that we should berate ourselves about. And then the final kind of cross-market indicator I'm touching on is inflation. We're looking at Russia, Turkey, Brazil, and Mexico. All of them within the last 20 years have come from a situation of extremely high inflation rates. This is the rolling 3-year average inflation to give you a kind of flavor of what longer-term inflation was doing. In some cases, like Brazil, they were coming from a period of hyperinflation where inflation had been running at thousands of %. How does South Africa stack up against that? I'd say pretty well. South Africa in the last 20 years came from an environment where average, kind of longer-term average rolling 3-year inflation in the early part, back in '97, was sitting kind of between 8 and 9 against other emerging markets that were well into double or triple digits. And inflation has been very stable, particularly since the Reserve Bank has been inflation targeting. So, again, in a world where you're buying fixed-rate assets and you're worrying about or want to consider where the inflation profile is going to be and consequently what your real return is going to be, then I think there's good reason to be reasonably comfortable that, at least as it stands right now, the Reserve Bank has done a great job. And inflation, since it's been inflation targeting starting in 2000, has averaged 5 3/4, a little bit below the top of its target band. And then what's been the result of that? And here we show that as far as foreigners are concerned, and here we show cumulative flows into the South African bond market from foreigners. 300 billion rands worth of inflows have come through the course of the period since the global financial crisis. And those flows have been pretty robust, even against a whole host of different global crises. Whether that's been the concern about Euro breakup, Brexit, Trump's election, or Nenegate. Interestingly, this year, despite the downgrade and despite the cabinet reshuffle and the change in the finance ministry, then we've had 20 billion rands worth of inflows from foreigners through the course of 2017 so far. So, my observation here is this money seems to be fundamentally sticky. It's not just hot money that's coming into South Africa. And after each risk episode where we've had some outflows, that capital quite quickly returns as the risk aversion slowly fades after the particular event. So international investors are looking for higher yielding opportunities, and I think South Africa's on their radar for some of the reasons that I've set out. And just a timeline to set it in context of the rand versus the dollar in terms of valuation. This point here is Nenegate. This is the point where, the ASISA statistics show us people took money into offshore funds at that point in time. The rand was the cheapest it had been in 20 years, and yet people, clients are taking their money, and possibly some advisors are taking their clients' money offshore. Those returns, as we saw, have been pretty disastrous. Don't sell cheap assets. Interestingly, for me, the narrative that has grabbed the market in general has been one of worrying about bonds and downgrades, which is all about our creditworthiness and our ability to repay our debt. And yet, actually, the asset class which has generally hurt investors in terms of bringing returns down has been equities. And here, again, I think there are some reasons to be more optimistic. And yet, we see generally clients selling funds which have got equity exposure at this point in time. So what's been the challenge? We look at the last 2 years. This is cash over 2 years. Your 100 Rand in cash is now 114 Rand. Inflation is up 12. If you just got an inflation return, you would have had 112 Rand. So your cash has grown a little bit in real terms, but not much. But your equities have only grown to 109 Rand. So you're not only below inflation, but you're also behind cash. So there's I think there's the challenge for investors. You look in the rearview mirror, you say, my equities, I've got an asset that's extremely volatile, and yet it's delivered me nothing. So why do I want to hold that? And so we went away and we did a piece of work. We looked at, is there any information value in the return that we've experienced in the last 2 years from the equity market in terms of what the likely return is going to be over the next 2 years? And so on the horizontal axis here, we've bucketed the 2-year annualized real return from South African equities. So, where the annualized return has been less than 10%, that would be this bucket here. We are currently sitting in the bucket that says the return was slightly less than 0. Our real return over the last 2 years has been about -2, -3%. So as we saw just now, we're sitting kind of behind inflation. And then we said, well, given that, historically, what has then been the outcome in terms of the subsequent 3-year realized return coming from the market? And this vertical line gives you the range of outcomes in each bucket that you've seen in terms of the subsequent 3-year return. And the broad thrust of the chart shows that the higher the real return you experience over a 2-year period, the more likely it is that you get a lower return over the next 3 years. You are, where returns are very high, you are borrowing some return from the future. Where returns are low, the market is becoming cheaper, and the likelihood is that you're going to have better returns going forward than you've had in the previous 2 years. The red dots show the average of each of these series, and the red dots have a definite downward trend. So, if you have a 25% real return coming from South African equities over 2 years, then on average you're going to get no real return over the next 3, and that's the challenge. If we look at the particular segment that we are in, then the vast proportion of outcomes that we have seen in history, having had this experience, are positive real returns. The average real return has been about 14% from an environment where the equity market has delivered you a real return of between 0 and -5 per annum over 2 years. Now, we're not saying you're going to get a 12, 13, or 14% real return, but I think a modest single-digit real return from equities is definitely feasible, and the odds are kind of stacked in your favor. So if you're selling equities now, you're betting against this, and you need to have a lot of confidence about your macroeconomic or political view, I think, to validate that. So to bring this to a conclusion, we would say there are good reasons to be long risk assets at this point in time. It feels a very courageous position to take, given the news flow, but particularly with equities, we have lent some returns into the future. Now, one of the stories that I think is emerging amongst clients is as they become more concerned about the outlook, and they push their advisors to say, my equity returns have been poor, and I want you to get out of them because I can't stand it anymore, that they're moving into cash. And I would offer some caveat, one particular caveat against that's worth thinking about in that regard. When we look at bond returns, if we look at the yield that you buy a 10-year bond at, that's along the horizontal axis, and its subsequent 3-year return, there is a very tight clustering of the relationship between those two. You are receiving something pretty close to the yield on which you're buying the bond. But when you look at cash, the same is not true at all. You get a very wide dispersion of subsequent 3-year returns from the cash yield you're investing at, because that cash instrument needs to be reinvested and monetary policy switches. So you have some periods where you get wild fluctuations in the returns on cash. This kind of episode where you get a sudden change in monetary policy, and in that regard, we would say the Reserve Bank's already told us that they think monetary policy, that rates have peaked. And so one should anticipate that within some within some period, within the next year or two, interest rates are going to start to fall and you're going to be reinvesting at lower rates. So the fact that you can go and put money on a fixed deposit at 8.5% now is unlikely to mean that you can get 8.5% over 3 years. We would suggest you're going to get potentially significantly less than that. And so pulling all of those asset valuations together, the red bars here are Prudential's view on the real returns offered by different asset classes given current valuations. The grey circles are our view on fair value. Cash looks optically cheap, but obviously my caveat on cash is you're not going to get that because cash rates are probably, unless cash rates stay where they are, because cash rates are probably going to fall. So the good news is, whilst there aren't any very cheap asset classes where the red bar is way above the grey circle, there aren't any really expensive asset classes. Most of them look kind of fair to modestly cheap. And if we turn that into a nominal, this is real return. If we turn that into a nominal return, how does that look? The asset classes are along the horizontal axis, and their expected nominal return over the next 3 years, using the framework you've just seen, suggests equities delivering a kind of lowish double-digit return around 13%, coming down to about 7.5% from cash. Global assets, these are RAND-denominated returns from global assets. International equity delivering you 8. It's not a bad return from a hard currency asset that diversifies your portfolio, but it's challenged because the RAND is a little bit on the cheap side of fair. So if we take those returns and we plug them into, for instance, our inflation plus or balance fund, then this would be something along the lines of what we would say is achievable over the next 3 years. About 10.5% on inflation plus and about 11.5% on balanced, relative to an expected inflation rate of about 5.5%. So, you're generating a 5 or 6% real return coming from those assets, particularly helped by the fact, obviously, that that I think equities can now, having cheapened up significantly, can now deliver a kind of a decent return, I think, for our clients, and that comes through in these products that have medium and higher equity exposure. And so the challenge, I think, for you and your clients is to stand firm and suggest that that actually holding risk assets and actually stepping away from the seductive story of moving out of them because of what they've delivered in the last 2 years, that's probably not a long-term winning strategy for your clients. Thank you.